On today's episode, we're discussing what it actually takes to create financial freedom in Australia, what are some of the common financial traps people fall into when it comes to borrowing, and what's the difference between interest only and principal interest when it comes to growing a property portfolio. Our special guest today is Kurt Checketts from Blue Collar Money. Welcome to the podcast, mate. Thanks for coming on today. You've got an interesting history.
Yeah, I guess you could call it an interesting one, I suppose.
But probably not that uncommon at the same time.
Yeah, look, don't know too many diesel fitting mortgage brokers, but that's probably something of a point of difference, I suppose.
I guess where I was thinking sort of not that uncommon is you were at the mines working FIFO.
Yep.
And you moved into property investing.
Yeah.
And then what come first, moving into property investing or into finance first?
Probably just to rehash my story. Obviously, I grew up in New Zealand, a really small town.
We won't hold that against you.
Yeah, don't hold that against me, but really small town, not many opportunities. I left school at 16. I was obsessed with mining. So I was like,
Is that like being like a 5-year-old playing with little Tonka trucks? Or what was it about? Was it the money in mining?
It was the income, yeah.
Okay.
Like I heard the stories of people making money in the mines. I think most people have an affection that go to the mines to make money. So I was pretty obsessed, searching Seek at 16.
Nice.
Did an apprenticeship as a mechanic in my local town. And then, I think the day after I turned 21, I flew to Oz.
Flew the ditch.
Search of mining work. And I managed to get into mining in a pretty tough period where mining was not too good in Queensland. Coal prices were all down. But because I had a trade, I managed to get in there. And like my mum was always like, property's always going up.
Yeah, property's a good bet.
Park it in property if you're going to do well in your wealth creation journey. So, which was pretty special to see from my mum.
Did she have investment properties herself?
Look, mum was a bit of a battler, to be fair.
Yeah, okay.
She raised me on her own, paid her own mortgage off while I was, on a single wage. Really good at budgeting. She taught me a lot about money. She was always into me. So kind of had not really much to fall back on. But again, as soon as I sort of got that mining income, I was just like saving as much as I could.
Yeah, nice.
And I knew that it was a Commonwealth Bank at the time. I think I went and booked an appointment there and how much deposit do I need? I can't even remember. I think it was a 95% plus LMI deal. So I think I come up with about maybe 19 grand. And I bought my first property in Bundaberg.
So you bought your first property before you become a mortgage broker yourself then?
Yeah. I was only 21 then.
Nice.
Yeah, so I sort of bought that and I was like, oh, wow. Like I managed to buy a property with 19 grand and I could still save.
And out of interest, do you remember what that was worth?
It was 315,000 I paid for that one. That was in 2012. Yeah, current valuation I think they're seeing the other about 705.
And out of interest, did that move much at all in that sort of?
No, it did bugger all. Trust me. But I guess that's where I took a lot of learning out of it because again at 21 I had my first property and then I was like, all right, I'm going to learn more about property investing. So I jumped on remember Somerset forums that used to be kicking around, a property investing forum. I was on that. I went to webinars, I went to seminars, and I still
just being a sponge, taking it all in.
And I still managed to buy an off-the-plan townhouse in Brisbane. I got suckered in. It was a little townhouse I bought in North Lakes.
Was that your second property?
Second property. So I was 22 years old, number 2.
Because the Bundaberg, to take a step back, the Bundaberg market is somewhat performed similar to Cairns. It didn't do much until 2020.
Classic regional market, yeah. But I think at one point it went backwards.
Yep.
But I knew that if I held long term, I'd have to have some growth at some stage. I was lucky because I could rent it for pretty well what it was covering my bills. It was neutrally geared, so I was like, cool. Anyway, made this mistake on this townhouse. The day it settled, it was worth 40 or 50 grand less.
Yes, nice.
So there's a lesson in that. But to be fair, if I'd held it, that same property would be worth just maybe triple.
Yeah, right.
So, there's also a lesson in that, right?
And it's funny, those off-the-plan apartments get a lot of shit. If anyone's listened to any investment podcasts, listen to anyone talk sort of property, everyone says steer clear of them. Yeah.
I think we're talking the high-rise, high-density stuff. This was actually a little townhouse. To be fair, it probably would be good. But no, definitely do not buy high-rise off-the-plan apartments.
But I think everything does somewhat have its day as just risk profiles. There's certainly those small little blocks of townhouses. I think they're great.
Oh, they are great. Yeah.
And
I just panicked because it had come in way less than what I'd paid, and I think I just got really cold feet about that. But that didn't stop me from making a third mistake.
Continue on then.
Yeah, chasing cash flow. I think I went under contract on one in Port Douglas.
Okay.
Seeing those rental returns and just
short-term rental.
It was a long-term one. But what I didn't realise is that most people would take 6-month leases and bugger off during the wet season. Again, didn't calculate body corporate that accurately, and it was a huge cost in body corporate.
Out of interest, those first three, so the Bundaberg property, the off-the-plan townhouse, and then the Port Douglas, do you still hold them?
No.
Move them on?
Townhouse, I was like, I basically, after owning it, I basically managed to get the developer to basically give my money back.
Okay,
sold it again.
Yep.
So I think I lost like maybe 10, 20 grand. So after the Port Douglas one, I sort of was like, all right, I'm not getting this right.
I'm missing some pieces of the puzzle.
And I sort of just got on with life for probably the next 3 or 4 years. I was in my 20s, did a lot of traveling. I continued to save. I just went into some managed funds and learned some real basic investing principles while I kept my Bundy house. I was in Brisbane, just living it up, And
it was after that stint that you then come into the mortgage broking? When does that?
Yeah, so I think it was 2020. But basically, I've been in mining at that time for all my 20s, and I was like, well, I'm working with people that I didn't have much money, and I was like, it could sort of baffled me. Like I was like, man, I've got 6 figures in the bank. I've got property. I could invest.
What would the average FIFO worker be making?
And this is probably my epiphany about in 2020. So that we're all diesel fitters on 150k a year. Quite considerable income.
And especially when it's like what we're working week on, week off, 2 weeks on.
Yeah.
But so half the year you can't spend your money on anything. You've got your accommodation covered. You're not doing shops.
And I worked on my days off. So
in the mines, people are making 150k, and you're saying that a lot of them just didn't have $2 to rub together at the end of the week.
I think when it really kicked into gear was like, all right, I'm going to focus on residential mortgages, right? And I started doing people's home loans. It was a bit of a strange conundrum, but I was literally on site and I was doing people's home loans. I was financing them.
Nice.
It's cool. But then I was seeing their bank accounts, right? And I was like, what the fuck's going on here?
You're making bloody good money. Where's it going?
I stupidly thought that maybe everyone was as savvy as me, and that's that's where my Instagram thing comes from. So I was like, well, I think I can change this a bit. So I think I put a bit of a focus on doing the right things, budgeting, investing, and growing some wealth through property.
Yeah. Because you see it all the time, that lifestyle creep of people that were on 60, 70k, they go out to the mines, they double their income, but then they start buying the flashy new car and doing the flashy holidays and
see it all the time,
buying the Gucci handbags or whatever. Suddenly,
it's not hard to tick up a few things and live week to week on a mining wage.
And that's where the golden handcuffs, I guess, come in. Is they're then stuck on those incomes, working a job that they may not like, being away from their family for half the year. Yeah. But they're not actually putting that wage to use.
Yeah, so there was a bit of that, and sort of just lit a flame in me. I was like, well, I think if I'm going to be a mortgage broker, I want to center my business around actually the mortgage is a byproduct of having some good, connections. And now, we've got some pretty good other professionals pretty good business referral partners, and we're kicking along really well. But it is a bit of a strange thing that most people go, oh, what are you? You're a diesel fitter. I'm like, to fix dump trucks, and I'm writing people's home loans.
And after those three first properties, you've sold 2 of them off? Yeah,
I actually sold Bundaberg in 22. Play was there, I was like, keep it, but I was in a sort of a tax haven where I had no CGT on it. It was my primary residence, and I kept it like that for a while.
Yeah, it makes sense.
And I sort of had to make a call, and it was in a moving market. It's worth more than what I sold it for now.
And you'd heard the property was a good idea. Your mum had told you property was a good idea. You'd heard all these gurus sort of say that property is a good idea. You had those first couple of failures. What was the sign that you're like, actually, I can make this work?
I think I just learned from my mistakes. And I think most, particularly men, they generally learn by making
mistakes. Was property for a success?
Yeah, so I mean, property 4 was actually not my current PPR.
Yeah, nice.
But I'd spent, like, I subdivided.
Nice.
And I did the whole big shed. I went, like, I spent a lot of money, and I was like, and at the time, I was like, I can either invest again, which would have been probably quite smart too, or I can build my dream PPOR, because at the time, I was only like 28, 29. So I was like, I had a bit of a decision to make.
Yeah.
I still had quite good savings. So we went hard on the PPOR.
Yeah, nice.
Built the sort of dream house, and then I sold Bundy to then clear the debt.
Yeah, nice.
And then because I knew then I had an abundance of equity, I could then reload her.
And that's pretty unique to be late 20s, debt-free on dream home. That's certainly a pretty unique situation to be in.
Yeah, and I think it's underestimated how that it frees you up.
100%.
And then just to have all your debt investment is pretty special.
There's a lot of talk about rent vesting and so on and so forth at the moment, which I think absolutely has its place.
It does.
But as someone with a young family myself, having your primary place of residence paid off, yours, you're not paying any non-tax deductible debt, like there's something pretty unique about that, and I think that's certainly aspirational.
It's an absolute game changer, as you know. I see it all the time now. It's like, you know, if you've got your own occupied debt, you should be still having a strategy to pay that down quickly. And
to move into sort of where you are now in the finance broking world, you've been doing it since about 2019, you're saying, just pre-COVID?
I think I finished my study just at the start of COVID. I don't think I wrote my first loan till maybe, I'm going to say like maybe 21, part of 21 there.
So in the last 5 years, has there been any sort of common mistakes that you see time and time again?
Buying getting car loans and all that stuff first. You know, it just hurts you. I have it all the time. Like, hey, I want to invest in property. I've got a good income. I've got, good equity. And then, I've got 2 car loans and a bloody HICS debt. And you're like, please.
Please don't.
And it really does trim the ears. And then you're in a position where you need to either use equity to pay the car loans out or to get them the borrowing capacity, but then you eat into their equity. It's a really tough one, so if you can avoid the consumer debt, it definitely helps.
Because what's a car loan these days? What sort of interest rates are you looking at?
I stopped doing them. I farm them out now because half my social media is just like slagging them out.
It was a bit hypocritical to write car loans up to say what a shit idea they are.
Hey, Sean, we like that new Ford Raptor. Here's a 19% interest rate. No.
But it's even the fact that,
the cost of them, like you need 100K for some of these like 4Bs.
And very quickly, that 100K 4B's worth 50K is the problem. So not only are you paying interest.
Maybe the old Toyota might hold its value a little bit better, but like you're seeing repayments of anywhere near 1,500 to $2,000 a month.
And even credit cards is an interesting one. I was having a chat to a client the other day. They had a 10 grand credit card. They owed nothing against it, but just having that balance was inhibiting their borrowing capacity.
Because it's a limit. So you can do what you want with it. I get lots of people with credit cards. I think generally the more like decent people that are good with their money and they're building wealth, they actually use credit cards really wisely.
Yep.
I've always done that with like paying on home loans, keeping your debt away from putting all your money against your mortgage and then having your bills come off your credit card. Little things like that. But it doesn't work for everyone. It comes down to your habits.
You've got to be organised and disciplined.
If I give someone just takes a 10 grand credit card, but they don't have financial habits, they'll just go and spend it at the shops, like Kmart and all that shit, and never pay it.
Makes sense.
Yeah.
And is there any other sort of common mistakes, so outside of that consumer debt?
Oh, look, I think people that go from PAYG to self-employed. Happens all the time. Oh, hey, like I've just become a subby. Oh, how long have you been doing that? Oh, 3 months. Oh, sorry, mate, you can't actually borrow any money. Well, you can. It's going to be like 9% interest.
Yeah.
Do all your borrowing while you're on wages. And I think that's probably pretty solid advice because a lot of people are going out on their own and becoming self-employed these days.
And I think it's a bit of pre-planning there. So, we launched our business not that long ago.
Yeah.
Before that, we had another business that we're fortunate enough to sell. But there was a period where I was PAYG between those two businesses.
Yeah.
We actually bought 2 properties in that tiny little window. And it's just... anticipating what your next moves are, planning a couple of years ahead, and
Yeah.
knowing that once you go self-employed, you are really restricted in your borrowing.
Yeah, and I think it's just having good conversations with, a mortgage broker.
And what's the time period? So if someone has started being a subby or self-employed,
I mean, you can do a low doc loan, like two basses.
yeah, okay,
It's
yeah.
like annualized over that, in a self-declaration. But
It's probably not ideal though. What sort of interest rates are you looking at on the low doc?
Oh, yeah, it could be in the 8s.
Yeah, okay.
But a lot of people potentially go, hey, I'll just cop it for 12 months, and then when I get my financials, I can refinance.
Yeah,
so
I get
it's
that.
a short-term pain for a long-term gain. But again, it could have been easily solved by just doing it when you're on wages. But generally, they're all opening up lending now on self-employed people because it's becoming so common.
Yeah.
So like now we've got director's wages, 6 months director's wages.
Okay.
And it's about how long the ABN's been registered for too. So that's another piece of advice. If you're going to go out and subby, just get the ABN.
Register the ABN, let it sit there.
Yeah, all those little things. So, I think the banks are becoming more flexible. It used to be just flat out 2 years.
Yeah, because that was my, 2 years is what I'd always heard.
We can do a 12 months, generally a 12-month financial, 1 year's financials with maybe 18-month ABN to get something decent.
And I guess the other bit of advice from my own experience with different people over the years, it's somewhat contradictory when you're self-employed, you're wanting to minimise your income, but then you're also wanting to maximise it for serviceability. I'm sure that's something you come across.
I just copped quite a big tax bill.
Yep.
Because I wanted to borrow money.
Yep.
And for most people, they're like, why would you do that? But unfortunately, I can make more money with that leverage.
Yep, income.
Yeah, I can go to the market and I know a property in this climate, it's going to make good money. So, I cop the bill. But again, that happens all the time. Self-employed people, they go, I made 200 grand last year, and they send me their financials and there's 10 grand net profit.
Yeah, correct.
Because it's like, oh, far out, all right, stop writing everything off, mate.
Yeah, correct.
Yeah.
And that's such a challenge because it is such a contradiction as well. It's everyone wants to legally minimise their tax. That's just, you'd be stupid not to.
Yeah.
But at the same time, you want to maximise serviceability.
No, but I think people that are self-employed do have a little bit of an advantage because if you get a little bit creative with different structures when it comes to investing as well, right?
Yeah.
So there's some retained profits and bucket companies and stuff. I think the bigger you get in self-employed, you do have a little bit of an advantage.
So it's interesting, those different structures, and self-managed super funds is obviously something that's really emerged over the last sort of 10 years, especially people buying property in self-managed super funds. Have you seen much of that from people self-employed and PAYG clients? Yeah,
I think it's a bit of both. For self-employed people, probably the biggest hack is you're a plumber, you're a chippy. You pay yourself your wage, but you haven't been paying yourself into super.
Yep.
You should be.
Yep.
Pay yourself because that's your borrowing capacity in a self-managed super to get a loan, right? So pay yourself some super, but then what you can do is you can take what you've got in your super balance.
Yep.
Just for argument's sake, let's call it 200 grand, and we might go park that in a commercial shed. Self-managed super fund owns the shed, and then your business leases it off your self-managed super fund. So that it's basically your super you pay from your income is basically going around like this.
And when it comes to borrowing there, so whenever someone's borrowing, it comes down to serviceability and equity. When it's sitting inside a self-managed super fund, what sort of loan to debt ratios?
So they'll go to 80% like a commercial, but they'll now go to 90 in resi.
Yeah, interesting.
So I've just done another. That's
pretty aggressive going to 90. That's just as good as in personal names.
It shows the appetite from APRA. Oh, well, not APRA because they're not governed by APRA, I don't think. But it shows the appetite from the lenders that they're here to play in that space. It shows the strength of the property market also. And
what about serviceability? So if it's sitting inside a self-managed super fund, it's obviously the trustees of that fund.
Yep.
Is that serviceability getting checked against their income and their...
No, it's purely your contributions. So if you're on 180 grand a year or 110 grand a year, whatever, that's 12% super that your employer pays in. It's purely just that and rental income.
Ah, interesting.
And it's got to service the debt.
So that makes it very accessible for a lot of people.
Very accessible. And it's becoming super popular. And I think what we will see is trust-based lending's been bit capped from
Yep.
most of your mainstream lenders. Because it was getting abused by certain buyers agents, speculating, recirculating borrowing capacity. That still happens. There's still lenders for that. But self-managed super fund, I think people why should I not have my money just parked in a property and something I can see and touch, opposed to a screen that says I've got this much money and it goes up and down. I don't know really what it's actually invested in. Everyone's sort of a little bit shady on the old government, aren't they? They sort of don't know what they're up to.
But that's super interesting. So essentially, banks will lend up to 90%, certain banks, but most banks 80% against residential real estate.
Yep.
And then when it comes to serviceability, it's your actual contribution. So if you're a PAYG school teacher on 100 grand, you've got 11,000 a year going in as contributions. They're basically going to use that 11,000 for the serviceability against the loan.
Yep.
Nice.
It's actually quite simple. It's the structure that it's all held in. It's a little bit complex.
But I even the structure's an interesting one because you hear family trusts and corporate trustees and all of that sounds complicated from the outset. But once you've built it once, there's not actually that much to it. It's just these random terms.
It's just some more moving parts and a few more bloody fees and accountants.
A couple extra 40-page documents.
Yeah, exactly. But I think I seen some stats the other day, like the increase in residential property being held in superannuation funds has gone, it's quite strong.
It makes a lot of sense. So it's no different, I guess, to the stocks versus property argument, and debate's probably the right word.
We call them the stock brothers. Every time I put a post up about it, I always get someone in the comments trying to fight me.
And I think my take on it's the returns are quite similar when you look at the stock market versus property, but property for me comes out ahead because of the leverage.
Yeah, it always does. And it's exactly right. And back on the self-managed super stuff is it doesn't work for everyone.
Yeah.
And the reason it probably doesn't work is you've got to have a bit of time on your side, just like anything, for it to appreciate in value. And for my strategy is actually to have those debts, because they're on P&I, just pay those debts down. I've got a long way for them to go because at 60 I can sell them capital gains tax free. And then I'll go into stocks and shares, more liquid assets when I'm 60, but that'll be 60's problem.
But if you've got 200 grand in super, you can then essentially leverage that into $1 million worth of property.
Depends on your contributions, but the borrowing capacity, and it's not as probably as strong, but and the interest rates are slightly higher. But again, a $200,000 property into, say, I don't know, a $750,000, $800,000 asset in Trinity Beach that rents for $800 a week over 25 years, going to perform pretty well.
You're still 4 extra asset base compared to putting that money into stocks.
Even if it didn't grow in value.
Yep.
So
it's interesting to put it into those simple terms of what the actual mechanisms are for self-managed super funds, because I think a lot of people talk of it as a high level, but actually break it down and understand where the repayments come from, where the serviceability comes from, is certainly an interesting insight. Speaking there on principal and interest, it's a interesting sort of choice that people have when they're out looking at investing, whether they go interest only on their loan or principal and interest. What's your thoughts on that? What does it mean in real terms? How does it affect borrowing capacity, I guess?
Probably to start, principal and interest, obviously you are paying down the debt. Interest only, you are just paying the bank interest.
Yep.
So the 500k loan versus the 500k interest only, the P&I is going to cost you, I don't know, let's call it $600 a month more.
Yep.
So it's going to cost you more, but you are paying it down. It comes down to your overall strategy. If you've got a principal place of residence, that's non-tax deductible. So there's no point having an investment property, paying that down and it's tax deductible when you still should be focusing on paying down your PPOR. If you have no PPOR, then maybe you could look and you had the cash flow from the properties. But it comes down to cash flow, right?
100%.
It's really hard to hold lots and lots of negatively geared properties on P&I. I'm personally, I got all mine on interest only, my investment debt. I may look to put one on P&I and just start paying some of it down, just purely out of the fact I don't have a PPOR debt. But I think if you're trying to build a portfolio, you need to look at cash flow. But yes, it does affect serviceability. And it's essentially if it's a 2 years interest only term, it's essentially like giving you a 28-year loan because you've got to now start with the same balance at 28?
Yeah, talk us through that. So a couple of things I wanted to break down there. Firstly, so if it's a 2-year interest-only loan,
Yeah.
they'll essentially charge just interest for that first 2 years.
Yeah.
30-year loan, so then at 28 years, you're then going to pay a higher...
You're starting at a 28-year term with the $500,000 loan. So it's assessed at like as you wanted at 28.
And is it that difficult to then refinance that interest-only loan into another interest-only loan?
Yeah. So like most people go, oh, I want 5 years interest only. But I'm like, well, hang on. Is that going to impact your borrowing capacity? Because it does. It's essentially like a 25-year loan. I think we should be reviewing everything 12 months anyway. I think you can easily extend with the same lender. Say, hey, I need interest only again. Tick, 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 you're all good.
Yeah, nice.
Because you don't want to be like high and dry chasing them for that. But
So rather than going 5-year interest-only loan and then moving it to a 25-year repayment term, have a 2-year interest-only loan.
I find, honestly, like most people, investors, they're moving shit around.
Yeah, playing musical chairs, yeah.
Yeah, like if you're an active investor, you're probably going to be moving shit around. And like, if you're not, you should be reviewing your finances every 12, 24 months anyway. So I like the 2 years interest only. I think it's a bit of a sweet spot. I should be reviewing it within that 12 months anyway. But if you yourself, you probably want to buy another property or do something.
And when you go to the bank, so say I've got 4 interest-only loans.
Yeah.
When the bank's looking at serviceability, are they looking at my repayments on that interest-only period, or are they looking at it when it rolls over?
Some will. So like your second-tier lenders will just take it on what's the actual cost. But your majors, they'll be going, all right, what does it look like in 4 or 5 years' time when it rolls off? Yeah.
So
some pick the teeth out more than others. Because remember, like the debt on a lot of them don't actually look at all your statements. They just want to know, all right, this is what your debts are on your credit report, and it doesn't tell them what the bloody
interest only, or if it's principal. Yeah,
and they all have their own servicing, and that's why you get varying serviceability results at different lenders. And some will go, aren't all lenders the same? Well, they're not.
No, makes a big difference.
Yeah.
So essentially, very much case by case with each of the banks, how they're actually going to review those interest only loans, and it's not by default going to actually increase your serviceability having your lending serviceability versus your actual practical cash flow position.
Yeah, it's a real hard one to explain to people when it's going to cost you less, but then it's going to reduce your borrowing capacity. So,
yeah.
So you've got to explain it that when it comes off that term, you're starting with the same amount at a higher.
And in regards to interest rates, so is there sort of a general markup between interest only and principal and interest, or does it vary from bank to bank?
It's coming pretty tight now, right?
Okay.
I reckon it has anyway. Like it used to be like, I felt like 50 basis points.
Yeah, okay, yep.
Standard. You've always got an investment loading. We know like a vanilla CBA owner-occ deal might be 5.5 and it'd be 5.75 for investment, or 5.64. But like I said, I reckon they've come closer in.
Starting closer gap.
And I think that's off appetite for investment lending.
Yep.
I think banks would love interest-only lending. I don't know why they wouldn't. It's just sits there.
Correct.
And in the same each month. And I think so. Interest only, maybe 15 to 20 basis points,
which is pretty negligible.
Yeah, but the cash flow on this, particularly on you get these big loans, like you want to have that debt.
So if you've got $1 million worth of debt, you might be paying 0.2% more interest. So what's that? Is that $2,000 a year on a mil?
Well, We're like 6% interest rate, mil loan, that's $6,000 a month, right?
Yep. So then you might be paying slightly more interest on $1 million loan, but in real terms, you're not paying off the principal. So you might be ahead $10,000, or if it's $500 a week.
Yeah.
Probably need the calculator for this, but essentially what you're gaining by interest only is you're not having to pay that principal. So it's not hitting your pocket each week trying to support that.
We're investing in property for the capital growth, not the rental returns, so we're just worried there for the capital growth. So
it is that, like you are. But I think, one of the topics, and we might jump to it now, is a lot of investors do get stuck at that second property. They'll buy one, maybe two.
Yeah.
And I think a big reason that I think of that is that negative cash flow has a negative impact on their lifestyle.
Yeah.
And that's where I think if you can go to an interest-only position, you have less of an impact on your actual day-to-day lifestyle.
Yeah, 100%. Owner-occupier mortgages have also increased a lot in the recent years, which is really limits the ability to borrow. And that's where that rent this thing comes in, right?
Absolutely.
Like, it just doesn't make sense for someone to have like $1 million owner-occ.
Especially in after-tax dollars. So like the big thing for me, if you're a first home buyer and needing to borrow $1 million to get into the market, that's so like $1,000 a week or $1,200 a week. What would repayments be on $1 million at the moment? Oh, it's probably like
500, 5,500. But then you got P&I.
Yeah. It's a lot out of your pocket, but after tax. So, you've got to be earning the best bit of $200K to pay. Yeah. Even then, you'd be struggling to pay the $1 million mortgage.
Yeah. Yeah.
So coming back to why people get stuck on that sort of first or second investment property, obviously cash flow is a big one. There's only so much the average person wants to contribute each week towards an investment. Yeah. Do you think that's one of the main reasons, or is it serviceability, or is it a bit of all of the above?
Look, I think things have changed a little bit. I think the ability to grow a portfolio has become easier.
What makes you think that in rising prices? Because I'm sure there's a million people that would disagree with that statement. But
I think we've got the emergence of buyer's agents and mortgage professionals, right? So people that can actually get you into the borrowing capacity that you need.
Education, skills and services.
So you see how many like investment buyer's agents. They actually know if they know their shit, like, and then you've got a good mortgage broker. You'd be surprised, like people can get to 2 or 3. And obviously, you still need to have the income there. So it's kind of, your example is like, it's what are we dealing with here? But for the average mum and dad that have a normal mortgage, you can sort of do one investment and then still go to a second, third tier lender.
Do you think the fact that we are in a rising market also makes it easier for anyone that's already got their foot in the door?
Yeah. Yeah.
Just having that access to equity?
So this is the unquantifiable thing on affordability that we have at the moment is, I don't know, something like $3 million. 3 million houses sold between 2020 and 25. Like transactions, right? All at record profits.
Yeah.
So there's a lot of cash.
A lot of cash floating around.
It just doesn't surprise me. Like I've got people come to me the other day, I've got 600 grand to build a portfolio with. That didn't happen in 2019.
Because I had the exact situation. I met with some clients yesterday afternoon, and they bought a property here in Cairns for $410, I believe it was, their primary place. Mm-hmm. It's now worth just over $700, and now they're looking at deploying that equity into an investment property.
Yeah, mate, it's the most common scenario, and that's generally pretty easy is to get to that first one. Yep. But then again, we've got self-managed super, so that's another property. So you can start stacking assets in different things. But then again, if you put that second property in a trust, like you're at second, third tier lenders already though.
Yeah.
But you can still protect that borrowing capacity and don't hang me out to dry. But you know what I mean. And you can recycle that. So there's a lot more, we've become a lot more creative in the mortgage space, and we have the emergence of non-banks. Australia's got so many different lenders.
Yeah, interesting.
Like I spent a lot of time back in New Zealand over the Christmas break and talking to people over there. They've got like 4 or 5 different banks, and mortgage brokers have choice at about 10 banks. Like there's not the scale of things going on over there to actually create like this investment property focus. Whereas over here, people are just like, fuck yeah, I want to build a portfolio.
Let's go.
Yeah. And we've got all the lenders to do it.
So I guess that's where, you say it's never been easier to build an investment portfolio, and there's definitely a whole lot of people that don't own their first property yet that would probably be a bit begrudging at that comment. But
to tail into that though, it's probably never been easier to get into the property market.
I agree.
You got 5% deposit schemes. We've got guarantor loans. I've helped people without any deposit get into a property.
Do you think that it's more just an excuse and a cop out?
Yeah, I don't want to sound like Jack Henderson here, but like at the same time, like it has to be around your mindset.
100%.
And I like working with young, ambitious people and who take action, and that's who I like working with.
It's amazing how many people you see driving around in 70, 80 grand cars.
100%.
That are complaining they can't get into the real estate market.
Yeah, and I've got plenty of people at the moment that are on savings plans to get there. And mate, if you print off all your freaking bank statements and go, Didn't need that. Didn't need that. Didn't need that. You'd be surprised how many people have new phones. They have car loans. They have all this shit.
And is that keeping up with the Joneses that they feel that that's needed, or is it just laziness?
Killers, mate. Subscriptions. Everything's on subscription.
It adds up quickly.
Like, I think like people need to have a hard look at their finances and go, well, look, can I actually do it? Yes, wages probably haven't kept up with property prices. I'm not going to sit there and say that they haven't. But I don't know. I think if you really want to have a go, I think it's there for the taking.
I completely agree, and it's interesting. You sort of, at times I catch myself when I think about some of the properties that we've purchased in the past at like half the price they are today.
Yeah.
But that's just the way of the world. You speak to, your mum and dad that...
You didn't know they were going to double. you kind of thought they would, maybe, but then you were like, they probably weren't the best of properties on anyone's views, but you took action, you took the opportunity, and you're being rewarded for that. And
I think it's no different to like when you chat to, the older generation, your parents, your grandparents, whatever, and they talk about going to the corner store and buying a bottle of milk and a pie for $2. It's like unfathomable that prices were that cheap. And sure as anything, in another 30 years, we'll look back at today, just with the way inflation tracks, purely based on that, and look at prices today and go, what the hell? Like, that was a steal. I can't believe you got that for that.
Yeah.
Which is...
like exactly right, mate. And I think there's the amount of knowledge that's out there. And social media, yes, it's probably got some stuff that's a bit speculative, but there's a lot of good people out there on social media giving away plenty of free value. They're going to listen to this podcast, blah, blah, blah. But the amount of podcasts that you can listen to and go, oh, that sounds like a good idea. There's probably a little bit too much information. It's probably information overload, I suppose.
But I think what you just said before, it's about taking action. It's about if you're in a position that you're not happy with today, have a look at your bank statement. What do you need to do to get yourself in the door?
Yeah. I've had probably maybe half a dozen first home buyers that didn't want to buy in 2023, didn't want to buy in 2024. Didn't want to buy last year. Have bought, maybe bought into last year, but there's $200,000 difference. Couple in towns. I was like, mate, you got to buy.
Just pull the trigger.
Please, just pull the trigger. Can't take action. And then that's really hard. Like, it is really hard to say, mate, just take action.
And that's where I love that Warren Buffett quote of just like timing the market beats timing the market.
Yeah, there's plenty of people out there saying timing markets is another thing too, which I get. Like, you could argue like this property in Bundy that I did all right out of, like I still would hold it for long, and if someone entered the same market in 2018, they would have done the same result. But they didn't have to hold the property
for an extra 5 years.
Yeah, so there is that timing of the market, and it's becoming more prominent through like buyers agents going through different hotspots.
It is, I think, but like. More than I 100% agree with you without a doubt on that, but I think it's what I really think of when I say timing the market versus time in the market is pulling the trigger today, finding where is the best spot to park your money today, rather than going the market's going to crash, interest rates are going to rise. Donald Trump's going to start World War III. There's always something right there on the precipice.
Yeah.
And the news does a really good job of glorifying and the negative. And I think as humans, we're so quick to draw away from danger, draw away from loss.
Yeah.
And we really protect ourselves from the downside. And it's hard to imagine the positive upside for a lot of people.
But one thing I'm really struggling with lately is I'm basically talking myself out of work at times. Because people come to me and they say, oh, I want to buy an investment property in Rockhampton, for example. And I'm like, I kind of struggle with it buying in pockets that have already done 100% growth. And I try and say, look, it's already done this. It doesn't quite stack up to be going a little bit further. Have you looked at other markets? But it seems to be this human nature that because it's performed in the last 3 or 4 years, we must pile in now. And it's like, well, that's how value investing's not. You're not in value investing. We're looking to buy it when it's a bit cheaper,
So it's interesting. So we made all our money in Cairns. We made really great money in Cairns. But when we were buying up from basically 2013 to today, basically. But 2013 to 2020. Everyone was saying there's no capital growth. Cairns is a terrible place to invest. Why wouldn't you buy in Sydney? There's no capital growth, there's no capital growth, there's no capital growth. And I was like, well, 2004 to 2008 prices doubled in Cairns. Yes, we haven't had any growth for 10 years, but that growth will come, which is, it's an interesting one, trying to time that market.
Yeah.
And I'd be interested in your thoughts. So like Rockhampton, doubled in price, and you go, oh, maybe this is somewhere else better to be. Where do you think Cairns is heading? You're a Cairns local. You've been here a long time. A lot of our listeners are from Cairns.
I've got one property in Cairns, an IP, and it's in Trinity Beach. See, the interesting dynamic, right, that we can't really... We know how we don't look at the past to predict the future, but a lot of people do. So, there's pockets in Cairns that have probably done 90% growth, probably Mount Sheridan easily.
Pretty much the whole of Cairns has doubled since. It's coming close to... If it hasn't doubled, it's pretty close.
I got the data there. Some of them are in the 90s. Some of them aren't. So, but people aren't afraid to move now in Australia. So they're moving for lifestyle choices. And it's really hard to predict, but like how many people from friggin' Melbourne live here now? And how many people from different pockets of the world just call it place home. So Cairns has changed so much.
100%.
It's very, very hard to predict. I see a lot of value in the northern beaches, just based off the Mount Sheridans and that have gone through the roof. And I'm like, well, the property prices have somewhat caught up to the northern beaches. Sort of a bit of a stigma that the northern beaches is out of reach for people, but there's still buys out there in the sevens. And I'm like, well, if you can still get there in the sevens, I think there's value there. But once we get some land supply down that south side, that should subside some of that those prices. Once you can do house and land packages.
Because the beaches is super interesting in the fact that there's basically no land left.
It's very landlocked, whereas all our land supply is out in the south side. And we know that once supply comes to market, that's when prices generally subside. But we have a real supply issue here.
But even like from a construction cost side of things, like... wasn't that long ago that even in Trinity Park you could build a Ken Frost home for 400,000. Like,
I know.
There was really...
Every time I talk to a builder, the price is just going up. So I don't even know how... when Mount Peter comes online...
Because I think that stuff's all like 850, 900 already.
I know.
Which just...
Which is... Yeah, so you're still... And that's the way I look at it, is like you're buying things below market replacement costs. So are we going to see building costs just keep doing this, and then the step... Because a step used to be cheaper to build, remember? That wasn't that long ago. It's absurd, but so I don't know. Everything's changed so much. You
can pretty much guarantee inflation. At the end of the day, the RBA's goal is 2 to 3%. That's their goal. And realistically, it's probably 3 to 4% at the moment. It's more than that. So like that's the government mandate, is to devalue the dollar and drive up the cost of construction over the future, which creates a... It's just, I guess, part of the underlying facts of why property investing makes sense. Yeah, and then I think if you just look at it through a lens of... It's a supply and demand game, as you know, and we do have a very, tight market. I don't know if you noticed, but the stock to market at the moment... It's the lowest since 2010. Is that right? I was going to say, it is ridiculous. And I would say, so... 2010 was on the back of the GFC. The market had actually bottomed out. That was really when unit prices fell off a cliff, was around that 2010 in Cairns. And that's basically we're at the same stock levels at that. But right then was when the market started to decline in prices in Cairns, where right now we've just got an inundation of buyers. I was chatting to Carl Latham, local real estate agent. He had a property over the weekend, had 17 offers on it. So only one person can buy that. So then there's 16 buyers that missed out that are now got FOMO coming into this weekend. Yeah, I've got 2 that have just gone under contract, and to be honest, to get them across the line, I'm doing some really short finance terms, really clean, neat and tidy offers, not just the price. As you know, as an agent of real estate, it's not just about the price. 100%. You just want a confidence that it's going to go through. And it just sort of mind boggles me where it's going to hit, because we don't really have that much supply coming this year. There's no supply coming. And we've still got lots of people moving here. I think the risk is actually people coming here and can't get accommodation. Do you think that serviceability will be the thing that slows the market down across Australia? I mean, if we get rate increases, we're not long. This time last year, we were 75 basis points higher than we were, and we were all buying property.
So no, I don't think so. I think people probably see it as an opportunity to buy, but again, it's supply and demand. So like, there's freaking 17 people trying to buy a house, but we have things like second-tier lenders, 2% serviceability buffers. Like I said, the lending products out there is astronomical.
So where does it end?
I don't know.
People probably had the same conversation in the 70s and 80s and 90s,
this time
2000s.
last year, I was like, surely like it's going to see. But again, I'm just starting to see, that supply and demand play. Perth is in the same spot, right? Perth has got like something like 3,000 listings. Capital city, which is like, should be 5 times that.
Yeah, nothing.
So apparently it's just nuts. Like, I've done a few purchases over there, and both times I'm like, just go get a BA. You're wasting your time. There's like 40 people at this open. The BA's already got the secret sauce to the agent. They've got all the off market already. Just pay the money.
Makes sense.
Yeah, and they wouldn't have got without it.
Oh, it's just relationships.
Yeah, it is relationships.
It's relationships.
And the same in Brisbane. I've been doing a few first home buyers there. It's another really tight, constrained market.
Pretty much throw a dart at the Australian map at the moment, and a lot of markets are in there.
So to answer your question, I don't know. It's obviously going to have to be affordability that constrains the area, right? The local incomes, but another thing we can't quantify is we don't know what the fuck everyone does for a job anymore. Like, we've got all these people that are like reach out to get finance. Like, what do you do for a job, mate? Oh, I'm like an online coach and I make 500 grand a year. Sorry, what? You live at Trinity Beach? Yeah, I moved up from Sydney. I'm like, so like, you don't know what people's floating around income wise, and again, people sold made all this money, so they got bigger deposits. Yeah. So it's a little bit unquantifiable, and I don't know where it's going to end, but I guess it's
exciting. It's an exciting space to be in, and certainly all the signals show that the market's going to continue to motor for the foreseeable future anyway. Yeah, I think it'd be naive to say it'll go forever, but
I think we'll see. I don't know. I'd like to say where would you think Cairns' first $1 million suburb will be?
I think Palm Cove's already passed the $1 million mark.
A median, is it?
Yeah. Edge Hill's there, I believe.
Palm Cove doesn't count.
Palm Cove doesn't count.
Oh, is it really? For a house? It probably would be, because all the houses are all...
You are struggling right now in this current market to buy north of Irville for under 700.
Oh, yeah.
Like, that's gone. Like,
you need 700 for Warree.
Yeah. But like
the first homeowner scheme's got a lot to do with that.
Very much so. But like 700's buying you something pretty average in a reasonable area, but it's like it's hard. It's hard to buy something at 700. So to get something that would be considered like a family home in like a goodish area, you're looking at 850, 900. Mm-hmm. It's probably not that unconceivable to see that median price being in a mill very quickly.
Yeah, I'd have to say Trinity Beach. I looked at the other day. It's in the 8s, only low 8s median price, and I was like,
you go find me something under 900 then in Trinity Beach.
I think we'll find that data's lagged, but that would have to be my pick for the one that would probably hit the mill mark pretty easy.
I was having a chat with my wife, who works very closely alongside me, and the low to mid-range feels like it's up around 10% since September in real terms.
It actually is. Like,
same for same property. Like, if you go find 4-bed, 2-bath Trinity Beach for, identical property, same suburb, you're paying an extra 80 grand for it right now.
I've got a social media post coming out next week, just like some social proof, and we did a self-managed super purchase for a fella in the mines, and we put him into a Smithfield 4x2, like North Point, opposite side of the Standard Road there where I live, and 705 we picked up in July, but like that would fly just under an 8 now. So like,
probably not just under, probably over 8 now. It's slim pickings.
Yeah, it is really slim pickings. So, but it's in his super, and he's like, mate, this is outstanding. He's like, so yeah, it is. It's interesting to see where it'll land, mate.
Most definitely. To move on there. Someone wanting to achieve financial freedom, wanting to use property as a vehicle, do you think there's an asset base that they should be aiming for, be it in dollar values or be it on number of properties? And what sort of timeframes do you think it actually takes in today's And let's say average income, not someone earning 500K with an online coaching job that lives in Trinity Beach.
Yeah. I think you could define financial freedom too, though, because like everyone's a bit different.
Yep.
I think we've both paid our PPRs off, right? It wasn't no one gave me a gold medal. It didn't actually feel that good. It's like, oh yeah, it was like good, and then you're like, yeah, but it's not. Like I've still got rates to pay. Or
still got other
my
bills.
lifestyle. It wasn't like, it's a big chunk of change. I get it, but that's probably a good fundamental to work towards for most people is have the family home paid off. I think that's a financial planning staple.
And part of the journey that you got there was selling that property in Bundaberg, by the sounds of it.
Yeah. It did definitely help me. It was kind of like, all right, I get rid of one of my investments, clear that debt because I knew I could go again. But I didn't get that option without taking action in the first place, right? So, but then if we go back to like, what does financial freedom define it? I mean, there is some people out there that say you need to have X amount in residential, for example. So like my next play will be probably some commercial stuff. But ideally, just accumulate in the resi, sell down and maybe go into some more cash flow. 'Cause, as you know, like residential tenancies, rates and insurance and all that, especially in Cairns.
There's also an element of small dramas that creep in as well. So like when you've got 4 or 5 properties, you're not dealing with too many dramas each week or each year. Where if you end up with a portfolio of 15 or 20 resi properties,
I can imagine.
There's a lot of little headaches that creep in.
You just wouldn't check your emails.
It's not passive.
No, it's not passive.
And that's where I think, moving to bigger commercial assets, like what you're saying, makes a lot of sense.
You'd rather have like a long-term business, in your for 2-year, 3-year leases, given you paying all the outgoings, and you can sleep at night. That you don't have to, imagine how many people would reach out to you if you had like 100 properties or something. And Nathan Birch, I mean, take my hat off to him. He must. He did it at a young age too. Like, I mean, I was a big fan of him, but Christ, he must have like
so many little. But I guess it gets to a point where you've just give someone the authority that if it's under certain value, don't even ask me. Just make the right decision, and you just accept it as a business cost.
Yeah, you got to have that right rental manager to do it. But
say someone was wanting to build a $2 million investment portfolio.
Yeah.
At the moment, it's fair as like a general rule of thumb, sort of 6 times income sort of borrowing capacity. Is that about right? Mm-hmm. So that means that, if there's a couple on 200,000, they could borrow 1.2, 1.5.
Yeah, at mainstream lenders that are governed by APRA, yeah.
Do you think it's possible to buy 4 or 5 properties still in a couple of years, or is it longer timeframes needed? Or
yeah, depending on their income, obviously. You're talking like a couple $100,000 income. It's actually not that much anymore.
No.
Kids come into the play. They're not good for borrowing capacity.
Yeah. Would that be the biggest sort of hurdle? Is that serviceability factor once people have that first property?
Yeah, and it's also what you're doing currently. So having a big PPOR mortgage is going to massively restrict you. And so that's where that rent vesting thing is like quite a good strategy. But at some stage, you've still got to try and get yourself into a PPOR, I think, like unless you're just going to rent forever. I don't know how that plays out. And I have thought about it. I was like, what would I do? And I think I'd just accumulate. But then if you go and accumulate, sell down and buy a PPOR.
Let's take that step. So you're 25, you got no kids.
Yeah.
Let's say you got $100,000 worth of savings.
Yeah.
What are you doing? What does the next 5 years look like for you? If we're going to play a financial game driven by, you've got 5 years to get to yourself to a financial level of comfort, or as close to whatever you perceive that as.
Yep.
You got $100,000 savings.
Yeah.
You're in the mines on $150,000 by yourself.
Yeah, sweet. All right. So first one, you got to go for capital growth, regardless. It's you're renting. You're renting a room off a mate, so you're rent vesting. You're going to be in the Melbourne market for sure. Capital growth play, $100,000, 95% lend. You probably wrap it up for a 700 purchase. So it'd be like maybe like a Geelong play or something. And that'd be number one.
And that's pretty much chewed your 100 by the time you pay stamp duty.
Chew the 100. Yeah. Right? I think the caveat, if you can get this next one, ideally you can go a guarantor loan. So ideally, if your mum and dad owned a property, You can use their house as security and go 100% lend on that second one.
But if that's not an option, so you've bought the property for 700.
Yeah.
I
would then I would drop the price point down, and I'd probably go 2 apartment or 2 unit plays.
Yeah,
maybe,
nice.
at 95% lend, so splitting them in 2 50/50s, and then you've got potentially like maybe, if you could stretch it, maybe you go like two 500 grand units.
And I guess what I'm thinking is the $700,000 purchase, if that was to go up by, call it 10% for easy sums.
Yeah, 70, yeah.
You've essentially got the deposit for the first unit 12 months after that purchase.
Yeah.
And then you've gone from 700 in play to buying an apartment, say, for 500.
Yeah.
You've then got 1.2,
yeah.
which then if that goes up by 10%, you've gained 120.
Yeah.
And I guess that's where that snowball really starts to...
And again, say if we get capped, we know that we can't, if we buy number 3 in personal name, and we can't go back and get 4 because we don't have any borrowing capacity, number 3 goes in a trust. And then we go so we're recycling that one.
Yeah, that makes a lot of sense.
Number 3, to be fair, on a skinny lend and a skinny equity release, you're probably going to be going for that real cash flow play, right? You might be doing like a cheeky one better,
but even on like, if you're only on 150, if suddenly you're negatively geared $600-700 on $150,000 income, that starts to bite.
If they're renting, it's not too bad. Yeah. The biggest chunks that if you've got that big mortgage. Yeah, I'm doing one right now for a young fella. He's on like 220 grand a year. He's about to do number 2. By the end of the year, we'll do number 3. But he's lucky we're going to do a guarantor loan for number 2.
Nice.
Because he's just aggressive. He's just like...
He wants in. He wants to make it happen.
We did his first one last year down in Melbourne as well. So he's got 1, 2, and he's probably going to do a Sydney unit or something. But again, he's probably lucky he can do that guarantor loan. But once he's got that asset base of 3 properties, he's 22.
And I think people...
He's going to hold him like this. And he'll have...
People think I think a big challenge that I see from people that want to get into property investing is they think it's so hard. Well, it is so fucking hard to save money. It's very hard to save 30, 40, 50 grand. Mm-hmm. But once you've got $1 million worth of property sitting there, goes up by 5%, you've just saved 50 grand of equity.
It's a big hack, hey?
It's just that snowball is so real once you actually start building out that asset base.
And I think people go, I don't buy units. Well, hang about. Like, some of these unit markets in Cairns have outperformed fucking just about everything.
Yeah.
But it's affordability, right? And it's no different in Sydney, Melbourne, Perth, Adelaide, wherever the fuck you want to buy. At some point, they will have their day.
I think with the apartment market, there's 2 big things that I look for when it comes to apartments, and it doesn't matter with regards to location, but like apartments for me stack up if, firstly, they're at an affordable price point. Yeah. So like your first home buyers can access them, your 100%. Investors can access them, but also how far below replacement costs they are.
Oh yeah, and that's generally avoiding the big high-risey jobs. You're trying to get that one of 10 or one of 12. They're great. Lower body corporates. Queensland's not that good in body corporate space, but...
You look at Cairns though, and like you can buy some really nice apartments still for around that 450 mark in Cairns.
Yeah.
To build them and develop a similar product, you're looking at 800-900 at the moment.
It's ridiculous.
So like you're literally half the replacement cost. So for me, like supply is so constrained. There's the only way that we can get more apartments in Cairns is if prices double.
Yeah.
Which is a pretty compelling argument.
It's a hard one, like talking to developers, because just to get things to stack up. It's hard. There's too much red tape in this country as well. Too
much red tape, too much cost, but it does mean that I actually think apartments are a pretty good opportunity for buyers at the moment.
Yeah, they are, and they're not just here in Cairns, but we're seeing a lot of them in the outer suburbs of Sydney. There's a big price disparity there. Melbourne, I think anywhere where it's affordable, right? Because it's got more interest, because it's a lifestyle choice. People don't actually have as many kids anymore. They call it the Lego effect generally, so...
But even the affordability, like to borrow $1 million, you got to be on a pretty reasonable to buy a primary place of residence for $1 million. You got to be on a pretty reasonable income. Mm-hmm. There's almost an argument that you pretty much have to be in a relationship these days to be borrowing. Is that fair?
Yeah, I think so. I think you'll probably see the emergence of. I have actually seen it. Some lenders are like your spousal, so brother sister buy. I think we'll see the emergence of that banding together.
It's pretty much like, as soon as you so use that like 6 times lending. If you're in Sydney, which median price point of 1.3, I think I saw the other day.
Oh, I think it's more than that, isn't it? It was like, that's fucking ridiculous there. Everything's going to be 2 mil by 2030. I was like, oh yeah.
But that means you've got to have like a 250 grand income to be able to borrow to buy into that market.
Yeah.
Which
I think there's like a whole different level of wealth in Sydney.
Yeah.
I think that's
but Brisbane's moving to a similar situation.
It is, yeah.
And that's, I think you've hit the nail on the head there. Friends buying together, siblings buying together. It's probably the path forward for people that aren't in a relationship.
There would be some stories of people that we would never hear of who have probably put their balls on the line in 2019 and gone super hard into, say, the Brisbane market, who have probably retired now. Like they're not on the podcast, but I guarantee there's blokes that
I know there is. Cairns is no different. I've got quite a lot of mates that bought heavy in Cairns over the last decade, and both from a cash flow perspective are sitting on really, really good cash flow because of the price points they bought at, but also on a capital growth point of view, like they've
and like so it's properties created all these millionaires.
Oh, they are millionaires, but I guess millionaires sort of lost its term also now. It's all
but like that's like we've actually got a really strong middle class based off property. And I like having conversations with my tinfoil hat on, but back in John Howard's days, what was the Prime Minister before him? But they realise like now coming into a lot of people retiring, so essentially you have all these people wanting to go on the pension.
Yep.
And the government 25 years ago were like, we can't afford to do that. Otherwise we'll end up like the UK. So how do we stop that? So we're going to incentivise people by making self-funded retirees. And we'll do that through negative gearing. There's no CGTs, all these little discounts on property.
It was interesting though at the same time, and this probably isn't a coincidence, but you look at the amount of government housing, and that's been in massive decline over that same sort of 25-year period. So
hang on, we're not going to give you more supply here.
So they've incentivised property investors to get into the market.
Self-managed super funds, CGT discounts. You think about all these little incentives in our government for property. But
then they also stopped. So the government's gaining income through stamp duty and income through the different property vehicles, but they've also lost that expenditure of having to supply public housing. So they've put that onus onto the mum and dad investor. So it's an interesting...
Yeah, like I think everyone goes, oh, they're a bunch of stupid pricks, but at some stage there would have been some heads banded together to figure this shit out. And I think you'll find that that a lot of the reasons behind negative gearing, and that was like, we need to self-incentivise the mum and dads.
Interesting.
Like, me and you won't get the pension. I'm sure as shit won't.
Yeah.
I won't need it. So that's kind of worked, right?
100%. And to wrap up, mate, I've got a question that I always ask people when they come on the podcast. What advice would you give to 18-year-old you?
Oh, just buy more in Cairns, eh?
Load up.
Load up. Well, no, I think I had to think about this morning. I think I'd probably just back myself a bit more and saying that I did make some mistakes, but... you got to back yourself and, focus on income when you're younger. Yeah, don't waste your time doing something that's not moving the needle, eh?
I love your story and the fact that the first couple of properties weren't successful, but you learnt from them and took them into
I was good at taking action, but I wasn't really good at doing due diligence at the time.
But I think you look at people that have had a level of success, and that's probably such a common trait. They're willing to have a crack even if they don't have all the answers.
Yeah.
Because, I think that's when you start to learn, and you learn so much through those mistakes.
Yeah.
Mate, it's been an absolute pleasure. Thank you for joining me, and I look forward to talking to you soon.
Thanks, mate.